Welcome to this explainer. Look, right now, we are witnessing an absolutely monumental shift in African private equity. It's a total recalibration of global capital flows. The traditional institutional investors, they're pulling back. But who's stepping into the void? European family offices. And they are moving fast. For you, as an African general partner, this is a completely new climate. But here's the thing, you don't have to navigate it alone. Think of this explainer as our IR firm's strategic playbook. We're going to show you exactly how we can partner up to help you attract, structure, and actually capture this multi-generational European wealth. Let's quickly run through our game plan. We'll start with the patient capital shift, then we'll move into decoding the 5Gs. After that, we'll cover structuring co-investments, tackling the ESG-linked carry mandate, and finally, navigating European regulations. All right, let's jump into Section 1, the patient capital shift, escaping the illiquidity loop. To really grasp why European family offices are such a game changer for your fund, we have to look at the stark contrast between two very different investment philosophies. On one hand, you have the rigid 10-year institutional model. You know the drill. It literally forces you to manufacture rapid and honestly sometimes suboptimal exits, totally regardless of the macroeconomic reality on the ground. I mean, imagine being forced to sell a prime African asset just because of a temporary currency dip. It absolutely destroys enterprise value. But on the other hand, you have family office autonomy. This is patient capital. We're talking indefinite holding periods. As your IR partner, we help you articulate to these families exactly how their capital gives your portfolio companies the vital runway they need to weather those economic shocks and achieve real, long-term compounded growth. And here is exactly why this matters so much right now. The traditional private equity industry is literally choking on a $3.8 trillion global backlog of unsold companies. Yes, trillion with a T. We are seeing assets parked in continuation vehicles, which are then just recycled into yet another continuation vehicle. It's a crazy phenomenon known in the industry as CV squared. This massive illiquidity loop makes your unconstrained, decade-spanning African opportunities an incredibly valuable premium. That is, if it's pitched correctly to the right European wealth. Moving right along to Section 2, decoding the 5Gs, the macroeconomic framework. So to capture this capital, you really have to understand the specific macroeconomic theory driving these massive allocations. European capital isn't just blindly chasing quick internal rates of return anymore. No way. They are targeting specific structural growth drivers, which we call the 5Gs. First, Generation Alpha and Gen AI. These represent massive consumer demand and huge leapfrog technology opportunities. Then you have green initiatives and geopolitics, which are aggressively driving decarbonization and supply chain nearshoring. And finally, global debt. With debt costs soaring, these investors want real operational value creation, especially in private credit. What our IR firm does is map your specific portfolio directly to these 5 pillars to show them absolute perfect alignment. To really put this into perspective, let's just zoom in on that green initiatives trend for a second. In 2025 alone, driven heavily by European mandates and the EU's Global Gateway package, climate-related ventures captured an unprecedented 40% of total venture deal value on the continent. That is $1.5 billion flowing directly into sustainability, alternative energy, and green tech in just one single year. It's absolutely huge. So the million-dollar question, knowing exactly what these European families want to buy into, how do we structurally align your fund with this wealth? Well, that is exactly the operational gap our IR firm bridges for you. Because honestly, it's time to rethink the core structure of your fund. Which brings us to Section 3, structuring co-investments, the end of the blind pool. As African GPs, we have to recognize a hard truth. European wealth is systematically moving away from exclusively relying on standard blind pool funds. Globally, over 42.5% of family offices now actively engage in co-investments, almost half. This is simply what investors demand now. They want to bypass those onerous 2 and 20 fee structures that are so typical in private equity. By investing directly alongside your fund, they remove that fee drag, preserve their wealth compounding, and gain granular control over deals where they already possess deep historical domain expertise. But, and this is a big but, accommodating this massive influx of co-investment capital introduces a really severe administrative load. Suddenly, you have to structure single asset special purpose vehicles, you have to deliver bespoke hyper-granular reporting, and you have to negotiate incredibly complex information rights. It's a lot. And this is exactly why African GPs partner with us. You need to focus on finding the alpha on the continent. Meanwhile, our institutional-grade IR and back-office team flawlessly executes this entire complex co-investment operating model right on your behalf. Okay, let's hit Section 4, the ESG-linked carry mandate, ethics as an incentive. Beyond just the operational side, you absolutely have to fundamentally elevate your corporate governance. Look, passive compliance, it's officially dead. European wealth now demands strict adherence to the EU's Sustainable Finance Disclosure Regulation, or SFDR. We actively guide our GP partners through the rigorous and honestly, often intimidating process of structuring their vehicles as Article 8 or Article 9 funds. Just look at Amethyst Fund 3. They closed at an incredible 406 million euros, and a huge part of that was because they successfully achieved that stringent Article 9 classification. It proved beyond a doubt that sustainability was their absolute core objective. And to prove you're really serious, family offices are now demanding ESG-linked carried interest. What does that mean? It means if you fail to hit independently verified targets, like specific carbon reductions or local job creation, you legally forfeit a chunk of your performance bonus. Wow, right? It ensures your drive for commercial returns aligns perfectly with real local impact. Now, as you can imagine, negotiating these verified targets is incredibly nuanced, and that is exactly where our advisory expertise steps in. We protect your upside and ensure you aren't being unfairly penalized while still meeting their demands. Finally, we have Section 5, Navigating European Regulations, the Pathway to Capital. So, now that your operations and governance are perfectly aligned, we have to build the regulatory roadmap so you can legally market to these investors across borders. You face a critical and often pretty daunting choice between full AIFMD compliance and the NPPR route. Building a full EU-domiciled fund? Sure, it grants a marketing passport for the entire EU bloc, but without an expert guide, it carries exorbitant costs and a massive operational drag. Alternatively, you have the National Private Placement Regime, or NPPR. This allows for highly targeted country-by-country marketing, which is significantly more agile and incredibly cost-effective. For our African asset managers, we execute this agile regulatory playbook directly. Here's how it works. Step 1, we target very specific EU wealth hubs, where these families actually reside, like Germany or the Nordics. Step 2, we utilize highly respected offshore structures, like a Jersey private fund, which integrates seamlessly. Step 3, we register your fund strictly under those localized NPPR rules. And Step 4, we ensure you never, ever face the immense legal risk of relying on reverse solicitation. That's a strategy that is heavily scrutinized and aggressively penalized by EU authorities, so we keep you completely clear of it. The bottom line is this. European family offices absolutely do not view sustainable impact and aggressive financial return as mutually exclusive. It's not one or the other. For them, flawless corporate governance, verifiable socioeconomic uplift, and strict environmental sustainability are the absolute, non-negotiable preconditions for long-term outperformance. Capturing this historic capital transfer demands absolute operational excellence. But the good news? It's an excellence you don't have to build from scratch when you partner with the right IR firm. So I'll leave you with this. Think about exactly how your fund is structured today. Are you really ready to offer fee-efficient co-investments and flawlessly navigate complex NPPR regulations? The connection between massive European private wealth and incredible African entrepreneurial opportunity is widening exponentially. But the bridge to get there, it's complex. Partner with us, adapt your architecture, and let's dominate the next critical decade of African private equity together. Are you ready to make the leap, or will you be left behind by the patient wealth revolution?